$107,000. That's the gap. Two families. Same type of house, same city, same year, same income, same neighborhood, same 30-year loan signed on the same kind of Tuesday morning. Neither of them knows the other exists. One of them doesn't know the gap exists either. This is what 20 years of one decision looks like. September 2005. Bartlett, Tennessee. A suburb just outside Memphis. Two families, two title company offices, 3 miles apart, same paperwork, same pen, same signature they'd been writing since middle school. They don't know each other, they never will. But from that morning, everything starts to split. Path A. 3 bedrooms. Older build. The kitchen has linoleum floors that curl at the corner near the fridge. The carpet in the living room is beige and already worn thin in the path between the front door and the couch. Purchase price, $187,500. FHA loan, 3.5% down, 6.0% fixed. 30 years, monthly payment, $1,082. They walk through every room the first night with the lights on, then again with the lights off. Not because they're checking anything, just because it's theirs now. That feeling takes a while to land. There's an old nail on the living room wall, left by whoever lived there before. They don't pull it out. They hang a family photo on it instead. Month 4, they start paying an extra $150 toward principal every single month. They don't tell anyone. They just set up the automatic transfer and close the laptop. Nobody notices. That's the point. Path B. Same suburb, similar house, corner lot, which already feels like a win. Purchase price, $193,000. Conventional loan, 5% down, 6.0% per fixed, 30 years. Monthly payment, $1,099. $17 more than Path A per month. Nobody would notice $17. But month 2 the HELOC opens, $24,000. To do the kitchen right. Open concept, new cabinets, the linoleum is the first thing to go. We need to make it feel like ours. That sentence makes complete sense when you say it out loud. Makes complete sense when you're standing in a kitchen that doesn't feel like yours yet. You just signed the biggest financial commitment of your life and you want one thing. Just one thing, to feel chosen instead of inherited. The contractor finishes in 6 weeks. The kitchen looks great. Total monthly payment is now $487. $405 more than Path A. Every single month. Month 1, that gap means nothing. It's the price of a nicer kitchen. A house that finally feels like home. Nobody tells you what that $405 means in year 5, or year 10, or year 20. It just runs. The renovation made it feel like home. The mortgage made it feel like theirs. Those are not the same thing. March 2010. The housing crisis hit Memphis like it hit everywhere else. Slow at first, then all at once. Path A. The house is worth less than what they paid for it. Zillow says $149,000. They paid $187,005. They don't sell. They don't need to sell. They just keep paying. $1,082 every month, plus the extra $150 toward principal. 60 payments. Not once did they skip it. Not when the water heater went out in January 2008. Not when the car needed $1,200 in February 2009. They found the money somewhere else both times. Real equity, even underwater on paper, $38,500. They know the neighbor to the left, the Kowalski family. 2 kids, same ages as theirs. They know the neighbor to the right. Miss Carol, retired. Waters her garden every morning at 7. They know the guy across the street. Ray, electrician, quiet, waves every time he backs out of the driveway. They didn't try to build any of that. They just stayed long enough for it to happen on its own. Path B. March 2010. The promotion came through in late 2009. Salary up from $68,000 to $81,000. The timing feels like a sign. The realtor calls on a Thursday afternoon. Not by accident. Realtors in 2010 are calling everyone who bought in 2005 and survived the crash with equity still intact. She says, with what you have right now, you could really move up. The market is starting to recover. If you wait another 2 years, the window closes. That sentence is designed to create urgency. It works. They sell. After commissions, closing costs, and paying off the mortgage, $11,200 remained. $11,200. That's what 5 years of payments, a $24,000 HELOC, and one housing crisis produced in net proceeds. They put that toward the new house. 4 bedrooms, Germantown, better school district, $278,000. Not enough for 5% down, which means PMI, an extra $112 a month. New rate, 4.7%, lower than before. That part feels like a win. New total monthly payment, $1,599. Moving costs, new carpet, paint throughout. Another $4,000 gone before the first night. Total transaction cost of this single move, $16,800. Evaporated. The first week in Germantown, the neighbor next door knocks. Her name is Sandra. She brings a casserole dish covered in foil, says welcome to the street, stays for 40 minutes. Has a daughter the same age as their youngest. It feels like a good sign. It is a good sign. The market recovered. Path B celebrated. Path A didn't notice, because Path A never left the gap at year 5. Path A, equity $30,500, zero extra debt, mortgage dropping steadily. Path B, equity roughly $14,000, PMI every month, $16,800 already gone. Net worth difference $41,300. The gap doesn't announce itself, it just widens. Every month, quietly. 2015. The recovery is real now. Memphis is moving again. Slowly, but moving. Path A. The house in Bartlett is worth $163,000, still below what they paid. Memphis doesn't recover fast. That's just the market here. Mortgage balance $12,000. Real equity $51,000. The extra $150 toward principal never stopped. Not once in 10 years. 120 payments. It stopped feeling like discipline somewhere around year 3. Now it just feels like the way things work. Path A doesn't check Zillow. There's no reason to. February 2015. Ray across the street gets into a car accident on I-40 coming home from a job site. Nothing life-threatening, but his right arm is in a cast for 6 weeks and he can't drive. Path A drives his kids to school every morning for 3 weeks. Nobody asked. There's no group chat, no formal agreement. It just happens the way things happen between people who have lived across from each other for 10 years and actually know each other. One Saturday morning, there's a bag of oranges on the front porch. No note. That bag of oranges doesn't show up in any net worth calculation, but it's real, and it belongs to Path A in a way that no square footage ever could. Path B. The house in Germantown is worth $334,000. Equity, $74,000. Sandra next door has become a real friend by now. Their kids walk to school together. Saturday mornings sometimes mean coffee on the porch. The kind of friendship that happens slowly and then feels like it was always there. And then the letter arrives from the bank. Based on your current equity position and excellent payment history, you may qualify for a cash-out refinance at today's rates. Today's rates in 2015, 3.8%. They're currently at 4.7%. The math looks obvious. This is the part worth slowing down for. Because 3.8% is not just a lower number, it makes everything feel affordable. It makes every decision feel responsible. It makes $52,000 in cash feel like a tool instead of a debt. They refinance. Cash out, $52,000. $28,000 goes to the master bathroom. $14,000 goes to the backyard, pergola, landscaping, a gas fire pit that gets used 11 times the first summer and twice the second. $10,000 pays off a credit card sitting at 19.9% APR for 2 years. That last part is genuinely the right call. New mortgage payment, $890 per month. Term reset, back to 30 years, starting over. They don't think of it as starting over. They think of it as optimizing. That's what 3.8% does to a decision. It makes starting over feel like strategy. Low rates don't just lower your payment, they lower your resistance. That's the part nobody puts in the brochure. The gap at year 10. Path A, equity $51,000, no refinance, no reset, 20 years remaining. Path B, equity after cash out roughly $22,000. Mortgage reset to 30 years. $52,000 already spent. Path B is behind Path A by $78,000. Not because Path B made a stupid decision, because Path B made a decision that looked really smart at 3.8%, and the bank was very good at making it look that way. 2020. The world stops, but the mortgages don't. Path A. The house in Bartlett is worth $198,000. COVID did something strange to Memphis real estate. Even the modest neighborhoods moved. Suddenly people wanted space, yards, a driveway that belonged only to them. Mortgage balance, $71,000. Equity, $127,000. The monthly payment is still $1,082. That number hasn't changed since September 2005. 15 years ago. Think about what has changed in 15 years. A gallon of milk, a tank of gas, a box of cereal, health insurance, property tax. Everything moved. Some things doubled. That number didn't move. $1,082. Same as the day they signed. There's a coffee stain on the linoleum countertop in the kitchen. It happened on a Tuesday morning in March when their oldest called from school. She'd been accepted to University of Tennessee. The coffee cup went down too fast. The stain set before anyone thought to clean it. Nobody cleaned it after that either. It's still there. Not because they forgot. Because some marks are worth keeping. Path A doesn't think about the house much anymore. That's the thing nobody tells you about financial stability. It's not exciting, it's quiet. The anxiety moves somewhere else. The kids, aging parents, health. But the house isn't on the list anymore. The house is just home. Path B. The house in Germantown is worth $398,000. Equity has rebuilt to roughly $74,000. 5 years of payments into a reset 30-year mortgage. And then Zillow sends a notification. A house in Collierville. 4.5 bedrooms, better school district than Germantown. Newer build, bigger lot. List price $319,000. Rates in 2020 are dropping fast. 30-year fix sitting at 2.9%. At 2.9%, the monthly payment on $319,000 is $1,142. Less than what Path A is paying on a mortgage from 2005. It feels impossible not to move. They sell the Germantown house. After agent fees at 5.5%, closing costs, and paying off the mortgage, $47,000 remained. They put it all down on Collierville. New mortgage at 2.9%, $1,142 per month. New term, 30 years. They are 41 years old, and they just signed a mortgage that runs until they are 71. Nobody says that part out loud. Moving costs, new appliances, plantation shutters throughout because the builder-grade blinds look wrong in the new space. Another $6,000 before the first mortgage payment clears. Total transaction cost of this second move, $31,400. Gone. The week before the moving truck arrives, Sandra comes over. She doesn't bring a casserole this time. She just stands in the driveway for a while. They talk about nothing in particular. The kids, the neighborhood, whether the new family moving in will be nice. She says, "You have to come back and visit." They say, "Of course, definitely." They both know how that goes. Sandra waves from the driveway as the truck pulls away. That's the last time they see her. Not because anything happened, because nothing did, because that's what moving does. It doesn't end relationships dramatically. It just quietly makes them impossible to maintain. Their youngest asks from the back seat, "Are we almost at our new home?" They say yes. He looks out the window and doesn't say anything else. Later that night, when a neighbor in Collierville comes over to introduce himself, their youngest shakes his hand politely and goes back to his room. 2 weeks later, his teacher asks the class to draw a picture of home. He draws the house in Germantown. Not the new one, the one they just left. 2.9% doesn't just lower your payment, it makes 30 more years feel like a reasonable trade. That's the most expensive thing it does. The gap at year 15. Path A, equity $127,000, 10 years remaining. Monthly payment unchanged since 2005. Path B, equity $51,000, new 30-year mortgage. Combined transaction costs across both moves, $48,200 gone. Cash out from 2015, $52,000 spent. Net housing wealth gap, $124,200, not counting what $48,200 would be worth today if it had compounded instead of paid commissions. That number is larger. Nobody is calculating it. September 2025, 20 years since that Tuesday morning. 20 years since the same paperwork, the same pen, the same kind of signature. Path A, the mortgage is gone, not refinanced, not sold, gone. Paid off completely in April 2023. 18 years into a 30-year loan, 2 years early. $150 a month for 216 consecutive months did that. The house in Bartlett is worth $218,000. Owned outright. No bank has a claim on it. No lender has a name on the deed beside theirs. Starting May 2023, $1,082 that used to go to the bank started going into an index fund, same automatic transfer, same day every month. The same habit that built the equity now builds the portfolio. 26 months of that, $2,832 in the market, growing. The kitchen still has the linoleum floor, still has the coffee stain from the morning the oldest called about University of Tennessee. The nail is still in the living room wall. The family photo has been replaced twice. Different photo. Same nail. Miss Carol next door still waters her garden at 7 in the morning. Her hair is completely white now. The watering can is the same one she's had since 2008. Ray, across the street, put a new roof on his house last summer. He came over one evening and asked if Path A wanted theirs done at the same time. Said he could get a better price from the contractor if they did both together. That's not a neighborhood. That's infrastructure, the kind you can't buy. The kind you can only build by staying. Path A sits at the kitchen table on a Tuesday morning in September 2025. Coffee, same table, same window, same light coming through at the same angle it always has in September. The account balance on the laptop screen is different than it was 20 years ago. Everything else is almost exactly the same. And that's the thing. That's the whole thing. Path B. The house in Collierville is worth $387,000. It's a beautiful house. The landscaping is mature. The shutters are perfect. The neighborhood is quiet in the right way. Mortgage balance, $261,000. Monthly payment, $142. Years remaining, 25. They are 46 years old with a mortgage that ends when they are 71. That number just feels different at 46 than it did at 41. The house looks like success from the outside. From the inside, it is success. The life lived inside those walls has been real. The memories are real. The kids grew up in good schools. The neighborhood delivered what it promised. But there is a number that lives quietly in the background of every financial decision they make. 25 years. It's not panic. It's not crisis. It's just a number that doesn't go away. Here it is, clean. Path A, mortgage, $0. Equity, $218. Monthly housing cost, $280. Years remaining, 0. Path B, mortgage balance, $261,000. Equity, $126,000. Monthly housing cost, $142. Years remaining, 25. Total money Path B lost to transaction costs, fees, HELOC interest, and cash out spending, $111,000. Path A lost 0, the equity gap, $92,000. The total wealth gap including everything already lost, $203,000, before opportunity cost. At a 10% historical average annual return, the real gap is closer to $280,000. Same income, same city, same year, same starting line, $280,000. Path A didn't win because they had a better house. They won because they stopped paying to leave. Epilogue. The drive past. Path B is driving through Bartlett on a Tuesday afternoon in October 2025. Not on purpose. GPS rerouted around an accident on I-40. Took them down surface streets they haven't driven in 15 years. And then the old street appears. They slow down without deciding to. The house is still there. Same footprint. Same roofline. Same small garage on the left side. Someone painted it a different color. Beige is gone. Slate blue now. Looks better actually. There's a car in the driveway they don't recognize. A garden along the front path that wasn't there before. A wreath on the door. And the tree. The tree in the front yard. They planted it the first week they moved in, spring of 2006. Bought it at Home Depot for $14. It was smaller than their youngest at the time. A stick with leaves, basically. They planted it on a Saturday afternoon because it seemed like the thing to do when you move into a house. Mark the beginning of something. That tree is taller than the roofline now. They didn't know it would do that. They sit in the car a moment longer than they mean to. Not sad exactly. Not regretful. Something quieter than both of those things. The tree just kept growing after they left. It didn't know they left. It had roots and it used them. And 20 years later, it's taller than the house that was there when it started. They drive on. The GPS gets them back to Collierville in 22 minutes. The tree stays. They planted it. Someone else got the shade. Somewhere in Bartlett, Tennessee. A title company office off Stage Road. A young couple sitting across from a loan officer, Tuesday morning, September 2025. Tighter jeans than they'll wear in 10 years. Phones face down on the table because the loan officer asked politely. The closing disclosure is in front of them. Same paperwork, same pen, same kind of signature they'd been writing since middle school. The loan officer flips to the last page, points to the line, sign here, and here, an initial here. They sign. They don't know yet what kind of people they're going to be about this house. Nobody knows that on the day they sign. Nobody ever does. The loan officer hands them a copy, shakes their hands, says congratulations, it's a big day. It is a big day, it's also just a Tuesday. The machine doesn't know the difference. It doesn't care which path they take, it runs either way. It was running before they were born, and it'll keep running long after the house is someone else's problem, or someone else's foundation. All it needs is a signature. They gave it one. The rest is just time.